Most people think financial systems exist to spread stability. That's the story we're told. Banks smooth shocks. Central banks calm markets. Governments protect the economy. But here's the uncomfortable truth. Modern financial systems don't spread stability. They centralize it. They pull stability into a few key institutions and let everything else absorb the risk. And once you see how that works, you can't unsee it. Because it explains why crashes feel sudden, why bailouts feel inevitable, and why the system always seems stable, right up until it isn't. Let's start somewhere familiar. Imagine a city built next to a river. For centuries, floods were common. Small floods, annoying floods, but they spread across fields, homes, roads. Everyone dealt with a little damage. Then engineers arrive. They build dams, levees, barriers. Floods stop happening. People celebrate. Developers build closer to the river. Cities grow denser. Property values rise. Everything looks safer. Until the dam fails. And when it fails, the flood doesn't spread. Concentrates. That's how modern finance works. For most of history, financial risk was messy and decentralized. If a merchant failed, his creditors suffered. If a bank collapsed, its depositors lost money. If a kingdom overspent, its currency weakened. Pain was frequent, but limited. Then we decided that instability was unacceptable. So we built systems to absorb it. Central banks, deposit insurance, lender of last resort facilities, government backstops. Each one made the system feel safer. Each one moved risk upward, until stability itself became centralized. This matters right now because we live in the most financially engineered era in human history. More debt than ever, more leverage, more interconnected markets, more promises layered on top of promises. And yet volatility looks oddly contained. Markets panic, then recover. Banks wobble, then get rescued. Crises appear, then vanish. Feels like control. But control is not the same as resilience. To understand why, we need to strip this system down to its simplest parts. Forget finance jargon. Think of the financial system as a giant network of IOUs. Money itself is an IOU. A bank deposit is an IOU. A bond is an IOU. A pension promise is an IOU. The system works as long as everyone believes the IOUs will be honored. Now here's the key problem. If everyone tries to settle their IOUs at the same time, the system breaks. Always has. Always will. So the modern financial system was redesigned around one core goal. Prevent mass settlement. Not eliminate risk. Not remove losses. Just delay and concentrate them. Let's walk through how that happens. Start with banks. When you deposit money in a bank, the bank does not store it. It lends most of it out. Your balance is not cash. It's a promise. This works because not everyone withdraws at once. But historically, bank runs happened all the time. So governments stepped in. Deposit insurance. A brilliant idea. It told people, don't panic. Your money is safe. And it worked. Fewer runs. More confidence. More deposits. But here's the quiet trade-off. Once depositors stop worrying, banks can take more risk. Not recklessly, rationally, because the downside is no longer fully theirs. Risk doesn't disappear. It moves upward, from depositors to insurers to governments. Now scale that logic up. Central banks exist to stabilize the banking system. They provide emergency liquidity. They set interest rates. They calm markets with words alone. Most of the time, that's enough. But every time the central bank intervenes, it sends a message. Relax. We're here. Markets listen and adjust behavior accordingly. More leverage. Shorter time horizons. Bigger bets. Again, not stupidity. Incentives. Stability is being offered centrally. So risk-taking spreads outward. This pattern repeats everywhere. Corporations take on debt because refinancing is assumed. Investors chase yield because volatility is dampened. Governments borrow because markets trust central banks. The system becomes calmer on the surface. But underneath, pressure builds. Now let's talk about the uncomfortable math. Stability has a cost, and the cost is fragility. When small failures are prevented, they accumulate. Losses that would have happened early happen later, and they happen together. This is why modern crises feel different. They don't creep in, they snap. Think about 2008. For years, the system looked stable. Low volatility, rising home prices, sophisticated risk models. Then suddenly, everything broke. Not because one mortgage failed, but because too many promises depended on too few stabilizers. Once confidence in those stabilizers cracked, the whole structure shook. And what fixed it? More centralization, bailouts, emergency lending, money creation. The system survived, but it became even more dependent on its center. Fast forward. Every crisis since has followed the same script. Shock, panic, intervention, calm. And every time the interventions get bigger, because the system requires it. This brings us to the great irony. The more we stabilize finance, the more we need to stabilize finance. It's a loop. Now let's contrast hype versus reality. The hype says modern finance is sophisticated. Risk is diversified. Markets are efficient. Data models are advanced. The reality is simpler. Risk isn't eliminated. It's stacked. Think of it like a pyramid. At the base, households, small businesses, local banks. In the middle, major banks, corporations, pension funds. At the top, central banks and governments. As long as the top holds, everything below feels stable. But the higher the pyramid grows, the more pressure sits at the top. And here's the part that makes people uncomfortable. The top cannot absorb infinite risk. Governments have limits. Central banks have credibility constraints. Currencies have breaking points. These limits don't show up on balance sheets. They show up psychologically. Confidence, trust, belief. Financial systems don't collapse when money runs out. They collapse when belief does. Now zoom out. Why does this matter beyond markets and banks? Because centralized stability changes behavior everywhere. It rewards size, punishes caution. It favors institutions that are too important to fail. Over time, power concentrates, not through conspiracy, through design. When stability is centralized, those closest to it benefit first. They get cheaper funding, faster rescues, more tolerance for mistakes. Everyone else adapts. This is why inequality widens during stable periods. This is why asset prices inflate faster than wages. This is why systems feel fair, until stress reveals who is protected. And this brings us to today. We are living inside the most centralized stability framework ever created. Interest rates were held low for years. Balance sheets expanded massively. Markets learned to expect intervention. Now inflation appeared, and suddenly stabilizing one thing destabilizes another. Raise rates to control prices, and debt cracks. Support markets, and currency credibility weakens. Protect banks, and political trust erodes. There is no free move left. Only trade-offs, quiet ones, delayed ones, politically sensitive ones. This is where the story stops being technical and starts being human. Because centralized stability asks a simple question. Who absorbs the shock when the system can't? Savers? Borrowers? Taxpayers? Future generations? Every intervention answers that question implicitly. And those answers shape society. The system doesn't fail often. But when it does, it fails big. And each time we rebuild it with even more centralized stability. Because chaos feels worse. Until the next failure. So here's the unresolved question. If stability keeps moving upward, if risk keeps concentrating, if belief becomes the final backstop, what happens when the center itself is questioned? Not attacked, not overthrown, just quietly doubted. Because financial systems don't break when people panic. They break when people stop assuming someone else has it under control. And that's a kind of instability no central bank can print its way out of.